All right, guys. Welcome back to the show. This is your boy, Coach UV, and this is the Unique Trading Group. I got a special video for you tonight. I am excited, to present to you guys. This is a video for you, and this is the Memorial Day weekend edition to get you prepared for next week for the SPY. And it's going to be a two-part, a 2-in-1. Today, you're going to get some guidance for the SPY, and also I'm going to be giving you a risk to reward measure. Trading is about risk to reward, and so we're going to be diving into that. How can a trader take the best risk to reward? So I hope you guys are ready, got your notepad and your pencils ready. We're going to dive into it. Don't want to hold you long. So getting started, we have inside of the Discord, I had an announcement to make last week. This was, yesterday at 7 o'clock. Yesterday at 7 o'clock. I put out an announcement, for my precision trading course incoming. It is coming soon, I told the group I'm in the lab building something powerful for the Unique Trading Group, a clean, no fluff, 3-step precision trading trigger system. This course is dropping first for you inside of the Discord. If you're part of the Discord, yes, you get it. The private community. You'll get early access before it goes public because you've locked in, you showed up, and you stayed committed. This is built for traders who want clarity, smooth execution, and no overcomplication. Just structure, confirmation, and precision. Period. Here's a sneak peek at step 1. What to do. Step 1, market key levels. Previous day highs and lows, pre-market support and resistance, volume lows, gaps, and major trend lines. Define your entry, your exit, and your risk zones before the market opens. Be prepared. Be properly prepared before you enter into a trade. And use the if price comes here, I do this logic. Create a response plan, not a prediction. Let me repeat that. Use a if price comes here, I do this logic. Create a response plan, not a prediction. Set alerts at your key zones. Avoid screen staring and stay focused. Shouldn't take all day to get something charted on the chart, especially if you're working from a clear plan. You know exactly what you're looking for. Core reminder, we do not trade setups, we trade context plus confirmation. So let structure guide you and not emotion. So heads up for next week. I told you this video will be a update and guidance for you for the SPY going into next week. I see some juicy setups. You guys can 8 to 10x your money both ways, whether to the upside on SPY or to the downside. And for the beginners who are listening, to the upside when it comes to trading, I trade options on a stock chart. And don't worry, I'm going to show you the charts and go through some risk to reward and some price level guidance on the SPY. Whether you're new or you've been rocking with me thus far, I appreciate you guys stopping on the video. But again, we're going to be going over risk to reward. And I want to prepare you for next week. This is your Memorial Day weekend guidance headed into next week in a part 2 video for risk to reward. And so keep a heads up. Next week, the market is going to be closed tomorrow. Today is Sunday, the 25th of May. So we got a short week. It's a short 4-day week. So I want you guys to be very selective. It's going to be low volume plus slow momentum equals fake outs. We will have volatility. You can get some money out of it. But what I'm saying is we have to be very selective, being that it's a short week. And we have data releases. So this is not a week to swing heavy. We are day trading with intent, locking in profits, and moving on. The June wraps up first half of the year. I repeat that. The month of June wraps up the first half of the year, and we haven't even got to June yet. We got a week or so until we enter into a new month, which gives us a new monthly candle. So how we trade now sets the tone for the next quarter, the next 3 months to 6 months. So trade the chart in front of you. Let the trend be your guide. The edge gives you discipline. The edge lives in discipline. So let's go ahead and get to some notes. What we want to do is we want to focus on risk to reward. Remember, risk to reward. First, we're going to get into some curriculum, and then we're going to get into the charts. And I promise you, I will not keep you guys long. Stay tuned. It's a valuable video. I might do some crypto or some gold, but we're going to stick with SPY for the purposes of the lesson is what I'm thinking. SPY and risk to reward. So risk to reward. Using standard deviation in trading. Standard deviation is literally only 3 lines. 3 horizontal lines on the chart, and I'll show you that on the chart. 0, 50, and 100% levels. Okay, remember that standard deviation. It's only 3 lines. Sounds fancy, right? Exactly. Okay, let's not make this complicated. We like simplicity. All right, standard deviation means 3 lines, and I'll show you how to use that in trading. All right, so what is risk to reward? Risk to reward is a ratio used by traders to assess the potential profit of a trade relative to its potential loss. It helps in determining whether a trade is worth taking based on expected outcomes. All right, why does this matter? Understanding risk to reward ratio is crucial for traders to maximize profits while minimizing losses. Let me read that again. Understanding the risk to reward ratio is crucial for traders, no matter whether you're a beginner, an intermediate, or an advanced trader. If this is your first time listening, it doesn't matter. If this is your 1,000th time listening, it doesn't matter. If you're in trading, the risk to reward is for everyone, okay? The more you get into it and approach trading this way, the longer you stay in the game. The longer you do this, it becomes a business for you, okay? All right? And so, understanding risk to reward ratio is crucial for traders to maximize profits while minimizing losses. It allows traders to make informed decisions and manage their portfolios effectively because you're managing from a plan, all right? Risk to reward, all right? Understanding standard deviation in trading. Standard deviation is a statistical measure that quantifies the amount of variation of dispersion in a set of values. Again, standard deviation is a statistical measure that quantifies the amount of variation or dispersion in a set of values. In trading, it helps in assessing market volatility and the likelihood of price movements. And what is volatility? Volatility is when price moves sporadically up and down in big ways, all right? It's a lot of uncertainty, and so price will not be stable. It'll go to a level and drop, all right? It's a lot of people taking profits and being in and out of the game, all right? So, standard deviation, the 3 key zones when it comes to that. 0, 50, 100%. We spoke about that above earlier. Standard deviation, the 3 key zones, 0, 50, 100%. 0% zone represents the minimal risk with potential for small rewards, idle for conservative traders, all right? So this one right here is idle for conservative traders. The 50% zone balances risk and reward, suitable for moderate risk takers, all right? The 100% zone, the high risk when high reward potential, best for aggressive traders, okay? Now don't worry, I'm going over the curriculum, but I'm going to show you on the chart what this means, okay? Right, how to think in percentages, all right? This video is not only about guidance and risk to reward, but it's also about thinking in percentages, okay? Thinking in percentages is how all of this works, because you want to think risk to reward and you want to stay into the game. And so if you're thinking dollar amounts, let's say you took a loss on a trade, let's say you spent $500 to $1,000 and you lost more than 50% of that $1,000. So you lost $600 at $1,000. A trader who is not aware of thinking in percentages is going to be thinking in dollar signs, and they want to do what? They want a revenge trade. They want to get their money back. So instead of them using a detailed plan to be properly prepared to actually extract money from the market, you know, when the market makes money available, when those setups present themselves, they end up getting into a mind frame of they have to make this money, this dollar amount back, and they start forcing trades on the market. And the market doesn't work like that. There are certain times and pockets where volatility is present. The money is moving and flowing like water, like the ATM sound. And there's moments when the market does anything, and it can confuse a trader who's not thinking clearly when they're trying to chase trades and chase back money, a dollar amount, hint, of what they lost. Thinking in percentages, however, can help you to identify proper setups, all right, with your risk to reward measures, so that you can get percentage gains off of the money you invested, little by little, compounding your interest that you put in, all right? So, how to think in percentages instead of dollars. Thinking percentages allows traders to focus on the relative impact of trades on their portfolio rather than the absolute dollar amounts. This mindset helps in maintaining consistency and discipline and trading strategies. Common mistake most traders make. Many traders focus solely on potential rewards without adequately considering the risk involved. This can lead to poor decision making and significant losses. The path of least resistance, best risk to reward. Choosing the path of least resistance involves identifying trades with the highest probability. Let me read that again. Choosing the path of least resistance involves identifying trades with the highest probability of success and the best risk to reward ratio. This strategy minimizes unnecessary risk and maximizes potential gains. So we're not doing random trading, all right? We're thinking percentages and we're thinking risk to reward. We want to get percentages and increases off of the money that we invest. We're thinking like a business, all right? This is how you guys can 8x or 10x your money next week on SPY. Just understanding that. And even knowing that, price can move that much, you still want to think conservatively and lock in gains, not assuming that the market is going to go where you said, all right, or where you assume, but locking in money as price moves in your direction, all right? A really good rule of thumb to think about is, position sizing. If you have $100 and you want to spend that for the day and you know for sure $100 is the max you want to spend, then you want to break that down into thirds and put that money and add that money inside of a trade setup, but not all at once. If it's $100, the first setup, your entry, right? You want to put 25, 30. Your next one, you want to do another 25, 30, right? We at 60%. Well, now we got 40 left. Your last little standard deviation zone, you might want to add to that, all right? Or start shaving off, and you can do the repeat, the complete reverse of that. As you're scaling in, you're scaling out, all right? And that is a strategy. All right, so my final note, let's jump into the charts to see this applied in real time, all right? All right, this layout is designed for easy screenshotting or exporting into presentation, training videos, and that was the purpose of this, for you guys to see it, all right? Now we're going to hop over to the charts on the SPY, and we're going to see what we have here. Let's see what we have here, all right? All right, first we're going to focus on the three zones I told you about, the 0, 50, and 100% mark. All right, what do you see in front of you? All right, you have pendulum swings. All right, these swings up and down are human behavior, right? And we are in a range of emotion and human behavior, okay? That's what the price action is on a stock chart. It's human behavior. Range of emotion, pendulum swings, all right? So when it comes to risk to reward, as you can see in front of me, we have that 0, 50, and 100% mark. Now I want you to ask yourself a question. I'm going to make this simple. I want you guys to take off your thinking cap. That's right. Take off your thinking cap. Do not make this complicated. I repeat, spoiler alert. This is not complicated. Do not make this complicated. Okay? Simple. All right? Now, we have a green, yellow, and red. This reminds me of a stoplight. All right? Green is for go, yellow is for caution, red is for stop. You get where I'm kind of going with that? If we can take trades on an entry right here at a good level, all right, 0% mark. I wanted to take a trade towards the upside from 588, right? If I wanted to take a trade to the upside, which one of these out of the three, the 100% mark, the 50% mark, and the 0% mark, which one of these out of the three would be my best chance of risk to reward to the upside? All right, have your imaginary Jeopardy music in the background. Guys, take a moment to think about that, and I'll get back with you in a second. Which one of these marks is the best risk to reward if I wanted to take a trade to the upside? All right, you guys figured it out yet? All right, if you chose here, all right, and bear with me as I navigate this screen. If you chose this area right here, 0%, then you were absolutely right. The 0% mark will be your best risk to reward for the upside, okay? And that'll make sense more when you see an actual chart. Why is that? Because, first of all, if I wanted to take a trade to the upside, This will be my 50% mark. This is my first target. My risk goes below that first candle. And so what do you have here? You have, let's say my entry was here at 0% mark, right? That would be a candle. You can't see the candle because it's just a visual representation with this imagery, right? But if this was a candle, okay, that was a candle, right? And our 0% mark was right here, and this is the candle we entered in on, right? There was another candle that was down here, all right? And so if I entered in on this candle, okay, I want my stop to go here. This is my risk, the bottom of that candle. Okay, see that? My risk is the bottom of that candle, and I'm going to show you that on the chart. As a matter of fact, I can swing over and show you that real quick. Okay, bear with me as I navigate the screen. All right. Okay, where's a good example of what I am talking about? All right, let's use this area right here. Use that area right here. Okay, we're gonna use this area right there. Okay, so let's just say that it's right here, right? This area, this candle right here, this green candle, watch my cursor, this candle, all right, is going to be our entry pattern at that 0% mark. Remember, we talked about that on the other side over here, 0%. Now, if I'm entering in on this candle here, right, this is my 0% mark, my best risk to reward to the upside, right? Because we have our 0, our 50, and 100, right? Anytime, you can always see this, guys. You can always see this. Always put a box up here and measure price. There's your range, 0, 50, 100. Again, 0 down here for the example, 50, 100. All right, let me take that back off. You can always see it. Now, if I'm entering in right here, my stop loss and where I want to exit my trade, if it doesn't go in my direction, then that means that the price didn't continue up, but it broke back down, and I don't want to be in that trade. All right, if it's breaking down from what I entered into, then I don't want to be into the trade. And so where would I put my stop loss, my risk? My risk is below this candle. This candle here, that wick, okay? It is below. That's my risk. Where's my reward? My reward is way up to the upside at the 100% mark. We already passed the 50, which is the 21 EMA, the 21 exponential moving average, what I talk about a lot on my videos. I never take it off. It's an indicator that represents 21 days of moving of price action. It's an aggregated time, and they calculate 21 days of that, and that's what gives you this exponential moving average. But that's at your 50% mark. My risk is below the candle I entered in. I want to exit once it breaks that low price of this candle, which is 580 flat. All right, my risk is below there, but I entered in above the line, which is at 580.36. So my risk will be about 36 cents, but my reward is about $2, $3, $4, $5. Are you with me? Are you with me? I hope you are. Okay, so let's move back to the example so we can quickly move along. All right. I appreciate you guys staying with me thus far for this percentage and risk to reward video. Okay, so now that we know that, right? Okay, 1 second. Bear with me as I navigate this screen. Seems like we have some technical issues here. We have some technical issues, but it's all right. It's okay. Let's get back to the SPY. All right, here we go. Now we're back. All right, now we're back. Okay, so now you understand that concept. We entering in on that bar, but below there, our stop is there. Right, that was our best risk to reward for calls. Now, if we wanted to get into a sell and we wanted to go to the downside, then where would our best place to be for selling to the downside, right? Let's say we got into a trade here and we moved up. We're making our profit. We shave off. We left some runners and it hit that 100% mark. Most traders I know, right, the retail traders, what they'll do is they'll chase this moment. When the professionals or the more seasoned traders, we're already in at the best risk to reward, and we're taking our profits here at the 0% mark. I mean the 100% mark or the 50% mark. Whereas other traders are chasing. They're at the whim of us, being ahead of the game, and that's the difference between a seasoned trader and a rookie. Okay, and you have the pendulum swings. Price tends to want to go back and forth between these zones, back and forth. And so if I understand these zones, I'm trading from a place of structure. I understand this is what I'm trading with. And so I want to get in at the best risk to reward to the upside, lock in profits as it go. If it starts projecting to go back down, I want to plan for the best risk to reward back to the downside, locking my profits back at the zone we started from. All right. This is market structure, all right? Trading psychology, all right? This is the way you think about risk to reward. That is exactly the way you think about risk to reward, okay? You always want to be thinking about where is the location of where I'm trying to trade at. Where is the location of where I want to try to trade at, okay? And once you figure that out, this becomes really, really easier to you, all right? You want to be thinking that, all right? You always see these 3 marks on everywhere, every chart you see, all right? So now that you understand that, what we're going to do is, all right, we're going to actually use the SPY. All right, I'm going to take off all this on my chart. All right, go. Okay. Now, we have this same thing on the SPY, right? Okay. We're going to erase some of these things off of here. We're going to erase these things. All right, we already used that example. You guys understand the 0, the 50, and the 100. Okay, now we're going to get into the real application of what we came here for. We're going to use the SPY chart. And this SPY chart is going to show us a nice setup. Have a nice setup for you guys. All right, you could 8x or 10x your money next week coming up. All right, and I got the perfect setup for you guys. All right, and we're going to be dealing with the 1 hour. All right, so we have the 1 hour time frame. Okay, take these off as well. I appreciate you guys bearing with me, man. Hope it's been valuable thus far. If it has been, hit that like notification. Gonna be ready for next week, and you got your little small lesson. Okay, now here we are on the hour. Okay, now listen, here's my notes. Let's make this simple. Now you can screenshot this, whatever you need to do. Okay, whatever you need to do to make this clearer. Take a picture of it, write it down. All right, here we go. SPY. All right, these are my notes on a 1 hour time frame. These are to act accordingly. All right, very specific. All right, at 576.90. I repeat, 576.90. All right, this is the beginning of a thin zone. I want to think about puts there. All right, puts below that price, 576.90. That's my setup for puts. That's a high probability setup to go to the downside. All right, if we fail 576.90, all right, we will be headed down towards 569. Now you do the math on that. I told you 6 to 8x to 10x on your money to the downside. All right, first of all, if we open below 579.11, watch my cursor right here. This is the previous close of SPY. Those that know, that watch me, know that we trade according to the daily close and open and or the weekly close and open. If price is below the previous close, I'm thinking bearish to the downside. Simple. If price opens up Tuesday and it opens up higher than the previous close, which is Friday, I'm thinking bullish. Simple, guys. Price is above the last price. It means it's going up. So we're bullish towards the upside. Simple in nature. All right. So first of all, that's the first thing to know about. If we are below 579, I'm thinking bearish. All right. We could be at 578. We could be at 579.05. We still below it, right? Then I want to start targeting the 576.90. I want to look for price to be a magnet towards those prices. But of course, in between 579 and 576, you have 577 and 588. You pick and choose what prices you want to go for, what trades you want to go. I'm giving you the best setup. The best setup for a flush down here for a nice payday, really fast, is going to be at 576.90 for puts, the beginning of a thin zone, right? So puts below here, 570.90, and we want to target 570, okay? That's at least a 5-6x reward right there, okay? You can leave some runners, don't be greedy, depending on how many contracts you buy, all right? Above, we have calls above 580.36, right here by the 21 SMA, all right? Retracement zone. Now I'm going to make this a little bigger for you, all right, so you can see right here, all right? This box on the hour, this is a range, and ranges act like magnets. I talk about this a lot, and it goes back and forth. We do have a little range here, all right? In between this range are going to be scalpers, right? In between 580 and 576 are scalpers. That's 2x, 3x for your money, all right? All right, I'm not going for those trades unless I just change my mind Tuesday or Wednesday or whatever day it happens. All right, in between 580 and 576 are scalps. That's like 2-3x. The trades I'm giving you guys are 6 to 10x. So you listening to this video, you can rewind it and watch it again, study it. But I'm telling you, between these two zones are scalping money. The best setups for parabolic moves and momentum shifts are above 580.36 for calls to the upside and below 576.90 for puts. So if we break above 580.36 for the upside, all right, I want to first target 587, all right? 586 and 587 are my first targets, all right? You heard it first from Coach UV. Calls above 580.36 for the SPY, all right? Calls above 580.36 for the SPY. I want to target 586 and 587, all right? We could see further momentum, but I want to lock in profits and assess and see what happens, okay? And below 576.90, I want to target 569, all right? 569 and 570. These are your targets for the SPY, okay? These are your targets for the SPY. I hope you guys found this video helpful, okay? If you found it helpful at all, do me a favor and hit that like button, okay? It helps YouTube know that these are valuable videos for the community. And if you find it valuable yourself, make sure you share it with friends or family that might be interested, all right? I made this channel for the people who want to learn how to trade, who want to get some good guidance and learn some things about trading so that they can have a good foundation on their journey. And this has been an episode of the Unique Trading Group's Memorial Day Weekend edition, all right? Memorial Day Weekend edition to prepare you for next week. This is a percentage talk type of video, also risk to reward and guidance for the SPY. So this has been a learning lesson and also a guidance packed into one, all right? Risk to reward, how to think in percentages and not dollar amounts, okay? I hope you guys enjoyed the video. Like I said before, always remember to define your entry, your exit, and your risk before every trade. This is how you stay into the game, seeing high probability setups, preparing the way we're preparing now so that we're able to just move effortlessly when it's time for the market to open. All right, guys, this is your boy Coach UV. If you want to join a thriving community where like-minded people like me and you trade every day, or if you want to trade alongside me live or get coaching calls, all right, all those links are down below in the description. The Discord is free, all right? If you want to try out a nice book about trading options, if you're into trading options, I also wrote a book that I published last year, all right, for the trading community, whether you're a beginner, immediate, or an advanced trader. This book has insightful guidance. Someone call it a Bible, a guide for trading. All right. So again, I appreciate you guys watching tonight, and I hope that you found it valuable. Until the next time, peace.